the big appeal of Bitcoin is it's not physical. It doesn't have weight. You can settle anywhere with anybody in a few minutes. And so gold has always been too heavy, too slow, and you can't really ship it across an ocean. And if you do, now you're getting tariffs. So I really think it just reminds everybody why the digital version of gold is better than actual physical gold. And I think it's going to catalyze a new wave of institutional adoption of Bitcoin.
Hey guys, welcome to Everyday Finance. Bitcoin is still going up strongly. Its price is just above 120,000 and getting closer to its all-time high from the summer. Key technicals are still positive, with rising volumes and strong support at 118,000, which makes it more likely that prices will keep going up. There may be a short-term drop too, 110,000 to 112,000. But most experts see this as a good opportunity to start over before the end of the month, when they expect prices to reach 124,000 or higher. Strong lack of fear and greed in the stock market shows that investors are very confident. This is happening as usage speeds up, especially as scalability solutions like Bitcoin Hyper get more attention. These are meant to speed up transactions and make the blockchain more useful across chains. Michael Saylor recently said that the bear market was over and boldly predicted that Bitcoin will eventually hit 1 million. He stressed the importance of steady accumulation by saying, "If you don't stop buying Bitcoin, you won't stop making money." Long-term buyers agree with him. They see Bitcoin as a way to build wealth that will last. Bitcoin's strong price, action, growing infrastructure, and strong support from influential figures all help to strengthen its place in both individual and institutional portfolios, which is good news for the rest of 2025.
I still think the vast majority of the capital flowing into the space is flowing into Bitcoin. We've gone from about 60 companies capitalizing on Bitcoin to 160 companies just in the past 6 months. So I'm laser-like focused on Bitcoin. I think Bitcoin is digital capital. I think it's going to outperform the S&P index over the indefinite future. And I think it's the clear global monetary commodity in the world right now. So it's the lowest risk, highest return, most straightforward strategy if you want to outperform the S&P and if you want to inject vitality and performance into your balance sheet. I think there's an explosion of innovation across the entire crypto economy, and on the margin, it's really good for everybody in the digital asset space right now. I think the big idea is $100 trillion plus of capital in the traditional equity capital markets and traditional credit markets. And what we're focused on is delivering digital asset-backed equity and digital asset-backed credit. And I think those credit instruments and equity instruments are just going to outperform the traditional fiat credit and traditional fiat equity instruments all around, and capital is going to flow into the digital economy. Yeah, the real compelling idea of a Bitcoin treasury company is we hold a huge stack of Bitcoin, about $74 billion worth of Bitcoin. Bitcoin's a 21-year duration asset. You got to hold it for 21 years if you want the full potential. And it's about 50 vol and 50 ARR. Most people don't want that amount of volatility, even though it's got that performance. And who wants to wait 21 years? So what we've done is we've created structured Bitcoin in the form of Strike, STRK. We give you the Bitcoin upside, a guaranteed dividend, and principal protection, and that's an alternative for people that don't want the roller coaster. We've created a long duration senior credit instrument called Strife. Think of it as a 21-year Bitcoin-backed bond. Pays about 8.5% dividend yield right now for people that just want that quarterly dividend yield and a seniority in the capital structure. And then you've got a high yield long duration instrument called Strife. It's actually paying like 11.5% dividend yield right now. And so that's for people that want high yield forever. And they'd rather have 11% quarterly than take that's guaranteed than the roller coaster of Bitcoin. And then the most exciting thing we've done just a few weeks ago, it's the biggest IPO of the year. It's called Stretch, STRC. And STRC is like a monthly Bitcoin-backed bill. And so think of it as a a Bitcoin alternative to treasury bills or money market funds. It's 9% dividend yield, monthly cash pay. And if you just want to park short-term cash and get paid 9% dividends and have it powered by Bitcoin, you're not taking duration risk on the interest rate. You're not taking the Bitcoin volatility. And that's our most successful offering to date. Well, right now we've had really extraordinary demand from retail. In our last offering, I mean, we started with about 30 or 40 million of retail demand on the first preferred, and then it increased to 60 million on the second preferred, and then 120 million on the third preferred, and about 600 million on the fourth preferred. So retail's off the charts. We've also got a lot of institutional long investors, people that are holding it. Look, if you like Bitcoin or if you like MSTR, these are all pretty compelling for any pool of capital you've got. And then, of course, a bunch of hedge funds also got very excited about this. There's lots of different ways to trade these against each other. So a good mixture of institutional as well as retail investors buying into all these preferreds. It does. Bitcoin is digital gold. It's going to accelerate the migration of capital from physical gold to digital gold. Bitcoin lives in cyberspace, no tariffs in cyberspace. The big appeal of Bitcoin is it's not physical. It doesn't have weight. You can settle anywhere with anybody in a few minutes. And so gold has always been too heavy, too slow, and you can't really ship it across an ocean. And if you do, now you're getting tariffs. So I really think it just reminds everybody why the digital version of gold is better than actual physical gold. And I think it's going to catalyze a new wave of institutional adoption of Bitcoin.
Tom Lee recently talked about the adoption stage of Bitcoin and stressed that buying now is still early because 95% of buyers don't have any exposure. This shows how far Bitcoin is from being accepted by most people. He said that the number of Bitcoin wallets now is like the number of people who used the internet in 1996, right before it grew really quickly and became popular all over the world. The comparison makes it seem like Bitcoin is still in the early stages of its acceptance curve and has a lot of room to grow. The number of wallets is still going up, but not many people are using them. This shows that the market as a whole is still in the explore stage and not yet fully on board. The network impact of Bitcoin could make it much more popular very quickly as more people, businesses, and regular people use it. Is less interested in the short-term price of Bitcoin and more interested in the long-term growth of users and traders. He sees Bitcoin as a new technology that will grow a lot in the coming years.
First principle is we want to prioritize efficiency and innovation over friction and bureaucracy. The existing system prioritizes friction and bureaucracy. Everything takes too long, too many lawyers, too much money. So how do you prioritize efficiency and innovation? Well, you start with simple principles like don't lie, cheat, and steal. Then you define data structures for each asset class. What are the common data structures, right? This is how you write a computer program, right? It's not that complicated. If, for example, you want an ABT, you want to know what kind of asset is it? Where's the asset stored? How do I know the asset's there? How many of the assets are there? Who's the counterparty, etc. And you would have a different data structure for a currency versus a token versus an NFT versus a commodity. But once you define the data structures, every digital exchange in the world can support those data structures, and then you can create a client that publishes the data structures. You create all the audits. So that's standardized disclosure. That reduces the friction. Instead of like 200 pages of custom legalese for every security, you've got one data structure, and you convert a 3-month process into a 3-hour, 3-minute, or 3-second process. And the second idea is industry-led compliance. If you define the data structures, then the exchanges can collect and publish the data, as a service to the issuers, to the investors, to the other traders, etc. And that helps you get to the third element here, which is cap the cost. If you want it to be a real business, you can't afford to spend more than 100 basis points of the assets you issue in order to issue them. Saying is, if you wanted to raise 100 million, you definitely can't spend more than $1 million. Now, 1% might be a big investment banker fee, or a fee you might pay. I came public, and when we came public, sometimes, the fees were up to 6% for a small deal, 3% for a bigger deal. But, we might pay 1 or 2% for a big deal if we're doing a bond deal. But here's my point, the big point. It costs $10 million a year in order to stay public, to be compliant, and you might spend $30 or $40 million to get public. And so it's pretty obvious that if you want to raise $1 million, you can't pay $40 million for an insurance policy, and you can't spend $10 million a year in order to raise $1 million, right? It's kind of like saying you gotta basically buy a $10 million insurance policy to publish a website or express opinion on X. Or to post a video on YouTube, you got to buy a $10 million a year, liability insurance. I definitely can see it. And here's the sad fact, Balaji, which is they did do it in 1933 for all publicly traded assets. They didn't lose. If you read the history of money and banking by Murray Rothbard, something like 50 years ago in the last century, he wrote about the formation of the modern SEC, and he writes about the SEC 33 Act. And one thing that he points out long before the crypto industry was formed is he says the SEC 33 and 40 Acts, they were put in place to centralize control over the capital markets in Washington, D.C. and limit access to the capital markets to a very small cartel of large issuers that could be overseen by the government. And, he has another observation. He thinks it was the Rockefellers' interest edging out the J.P. Morgan interest and shutting down too much entrepreneurialism in New York City. Yeah, you think about it. I think there's a certain Stockholm syndrome, or remember in Star Wars, they say these are not the droids you're looking for, and there's this
Right.
Jedi mind trick. It's like, raising money from the capital markets is not for you. You're too small. That's not for me. I'm too small. That's only for billion-dollar mega corporations, but you're not that. So raising money is not for me. Yeah. So it comes down to the issue of, are you going to let adults take risks and lose their money, right? Are you going to impose a $10 million insurance policy to keep someone from taking a $100,000 risk? And if you do that, the result is that 99.9999% of the action can't take place because of the crippling regulatory burden, because the government wants to keep anybody from taking a risk or losing their money or making an investment that might not pay off. And it comes down to a free market view. Do you believe that free markets will make the right decision? Or do you want a centrally planned economy? And do you think a set of bureaucrats at the headquarters should just decide every single business decision and every allocation of labor and capital, and talent in the economy so as to, quote unquote, not make a mistake? I've lived through that, Balaji, because I came public in 98, and I think there were about 10,000 plus public companies. But over the next 20 years, 60% of them disappeared. And basically what happened was, with Sarbanes-Oxley and with the encroachment, the progressive encroachment of the regulators on the public markets, it just became so brutally painful and expensive and risky and anxiety-inducing to be a public company. People just said, screw it, I don't want to do this anymore. And they all went private.
Samson Moe just recently talked about what he calls a glitch in the matrix that is making Bitcoins rise faster. He said that a lot of businesses are buying Bitcoin in a roundabout way by taking advantage of regulation loopholes and loans. With no interest rates, this is increasing demand and driving up prices. Companies like MicroStrategy showed how to get cheap cash and build huge Bitcoin treasuries, which is now something that more businesses are doing. At the same time, Some governments are getting involved. They are using extra energy for mining, or even thinking about issuing national Bitcoin bonds as a way to protect themselves against inflation and fiat currencies that are losing value. Mao thinks that this trend is speeding up the process of hyperbitcoinization, which is when Bitcoin becomes the most important currency in the world. He thinks that suddenly fiat currencies will fail, which will cause a quick switch to Bitcoin as the best way to keep value. In support of this view, BlackRock CEO Larry Fink recently said that he believes Bitcoin could reach a price of $700,000 USD. He also said that sovereign wealth funds are looking into putting into the asset. He talked a lot about Bitcoin's role as a defense against inflation, rising debts, and currency debasement. He also warned that bad U.S. fiscal management could even let Bitcoin challenge the dollar standing as a reserve currency. BlackRock has been getting more involved with Bitcoin. Its ETF, which started in 2024, already has more assets under management than its gold fund. And new institutional liquidity products are being released on blockchain platforms. Mo's idea of hyperbitcoinization and Fink's support show that Bitcoin is becoming more and more seen as more than just an investment. It could also be the basis for the future global financial system.